for millions of individuals and families, Fidelity Investments represents a path towards financial security. But beyond the familiar name lies a complex and influential institution that plays a pivotal role in shaping the financial lives of countless investors. Chapter 1. Edward C. Johnson II. The Early Vision. Edward Crosby Johnson II wasn't your stereotypical Wall Street titan. Born into relative privilege in Boston in 1898, he was the son of a successful dry goods merchant. His path, at least initially, seemed destined to keep him firmly within the established order of Boston society. He attended the prestigious Milton Academy, a gateway institution for the East Coast elite. However, unlike some of his peers, his interests weren't solely fixated on the old money pedigree. The young boy had a desire to make his own mark beyond inherited expectations. During his time at Harvard College, he demonstrated intellectual inquisitiveness and a willingness to take on challenges. Following graduation in 1920, he did a brief stint in the U.S. Naval Reserve as a radioman during World War I. This seemed to reinforce a latent sense of discipline and focus. Upon returning to civilian life, Edward excelled at Harvard Law School. In 1924, Johnson joined the respected Boston law firm Ropes, Gray, Boyden & Perkins. There, amidst the intricacies of trusts and estates, a different kind of education began. His work exposed him to the very heart of financial machinery, the wills and holdings of wealthy individuals. He became fascinated by the intricate dance of asset management. His precise legal mind was well suited for dissecting the risks and rewards inherent in financial decisions. But Johnson's path towards investment wasn't entirely a cerebral exercise. Chance encounters played their part as well. During his brief legal career, he became involved in stock market research, perhaps out of sheer curiosity at first. This was the Roaring '20s. Wall Street was a beacon of both spectacular gains and equally spectacular losses. It was a heady, intoxicating era, and Edward Johnson found himself caught up in its possibilities. His attention was now firmly fixed on the world of stocks, bonds, and the beating heart of American capitalism. The foundation was laid for Edward C. Johnson II, not just to become a successful businessman, but to become a force shaping the investment landscape. Chapter 2. The Birth of Fidelity. The Great Depression had cast a long, grim shadow over the financial world. By the time the 1940s arrived, the once exuberant markets of the previous decade were still reeling. Investor confidence was understandably shaken. Many shied away from stocks and clung to the perceived safety of bonds or cash. At first glance, it might have seemed the most inopportune moment for a young lawyer-turned-investor to make a major risk in financial markets. Yet, Edward C. Johnson II saw an opportunity amidst the crisis. In 1943, it came in the form of the Fidelity Fund, a struggling mutual fund established in 1930 that had dwindled throughout the Depression and the early years of World War II. With characteristically calculated analysis, Johnson identified a mismatch. The depressed stock valuations had been brought even lower by wartime anxieties. This didn't seem to square with his belief in the long-term resilience of the American economy. He sensed an upside. If the war ended favorably and markets rebounded, there was money to be made. Oodles of it. While Johnson undoubtedly possessed a contrarian streak, he was a calculated contrarian. He didn't go all in on risky plays or purely speculative bets. Instead, his early decisions at the helm of Fidelity demonstrated a patient, almost methodical mindset. First, he shifted the focus away from the fund's previous emphasis on bonds. Instead, he favored the common stocks of established companies. This was not a wholesale gamble on a speculative recovery. It was a belief that fundamentally sound businesses, battered but not broken, would thrive again once peace returned. Second, and quite radically for the time, Johnson saw the potential in democratizing investment. The world of finance in the 1940s was largely an exclusive club for the wealthy. It was managed by intermediaries, often more focused on protecting their own fees than their clients' profits. Johnson envisioned a different approach. In 1946, he created the Fidelity Management and Research Company. Within this company, he established a dedicated research team focused solely on identifying promising growth stocks. This two-pronged strategy formed the philosophical backbone of the nascent Fidelity Investments. It was a belief that rigorous, in-house research could uncover overlooked or undervalued companies, and that offering these opportunities directly to ordinary investors could revolutionize the industry. This commitment to client-centric investing set Fidelity apart from the old guard. At the time, mutual funds were often sold through brokers who earned hefty commissions. These commissions weren't linked to company performance. Johnson, much to the chagrin of the brokerage establishment at the time, sought to cut out the middleman when possible. He believed that this reduced friction and that the approach aligned Fidelity's investments more closely with those of its customers. If the clients prospered, so too would Fidelity. In these early years, Edward C. Johnson II wasn't creating revolutionary new investment products. The basic mutual fund structure already existed. His genius, rather, lay in reshaping the relationship between an investment firm and the individuals it served. It was a gamble based on the belief that transparency, meticulous research, and a focus on the long haul would ultimately lead to trust, growth, and widespread access to the potential benefits of equity markets. Chapter 3: The Age of Expansion. Edward C. Johnson II's patient gamble paid off. The post-war economic boom transformed America. Prosperity returned, and so did investor confidence. Johnson had predicted correctly. Peacetime brought with it a renewed hunger for stocks with growth potential. It was the perfect environment for Fidelity's philosophy to flourish. However, merely being right about the market wasn't enough. To truly capitalize, Fidelity needed to both adapt to and drive the changing investment landscape. The 1950s and 60s saw the mutual fund concept take hold with the American public. Key to Fidelity's success in this area was making the process understandable and accessible. While Edward Johnson possessed a brilliant investment mind, he was keenly aware that most customers wouldn't have the time or inclination to decipher his stock-picking strategies. Simplifying the complex, providing educational materials, and building a customer service ethos centered around demystifying the investment world were key. If clients didn't trust this new way of managing their money, growth would have been stunted. Offering the right products put Fidelity ahead of the curve. How those products were bought and sold kept the company there. Fidelity would leave a lasting mark on the industry with innovations that were groundbreaking for their time. One such game changer was the introduction of computerized record-keeping in the 1960s. It might seem mundane in this age of artificial intelligence and cloud computing, but consider this. Before Fidelity adopted early computers, all customer accounts and transactions were managed by hand on paper ledgers. This was horribly inefficient. It was slow and prone to increasing error as client numbers soared. By betting on technology, Fidelity could scale faster. They could track customer data more precisely and improve overall service levels. Perhaps even more radical for that era was the decision to establish a dedicated phone center for investors in 1962. This was the precursor to the modern call center. It allowed clients across the country to get information and conduct transactions without needing to come into a brick-and-mortar branch or rely solely on snail mail. In a move that seems like obvious customer convenience now, it was a bold step that challenged the norms of a more traditional financial sector. It wasn't just technology that fueled Fidelity's growth. Edward Johnson understood that even the best analysis was only as good as the people conducting it. He placed significant emphasis on hiring and fostering top talent in all areas of the company. Fidelity developed a reputation as a place where smart, driven individuals could thrive in a challenging and rewarding environment. The focus wasn't just on luring the best away from their competitors. Fidelity created opportunities for individuals from diverse backgrounds. Women who were historically underrepresented in finance started making significant inroads in the company. They took on key roles in research and portfolio management. This fostered an internal culture that embraced fresh perspectives, something vital for any organization looking to stay ahead of a rapidly evolving market. It's crucial to note that even in periods of growth, Johnson did not lose sight of his core philosophy. He was famously adverse to chasing trends. He avoided the hot fad stocks that briefly enthralled less disciplined investors. His investment team was encouraged to follow rigorous research and focus on understanding the businesses themselves. It was this commitment to doing the homework that gave Fidelity the reputation for stability and long-term returns. Chapter 4: Growth Challenges and the Johnson Legacy. Despite decades of remarkable success, Fidelity was not immune to the inevitable storms that roil financial markets. The 1970s proved particularly challenging. Stock markets were stagnant, and there was an oil crisis. Moreover, soaring inflation created a cocktail of economic uncertainty. Mutual funds as a whole suffered as investors fled to seemingly safer havens. This was a pivotal test for Fidelity. Had it built a company that could weather adversity, or could they merely thrive during good times? The answers wouldn't come easily. Market downturns can expose hidden weaknesses, and Fidelity was no exception. Its heavy reliance on growth stocks made it vulnerable during the stagnation of the 70s. Some of its funds were hit particularly hard. These setbacks forced a period of introspection and recalibration. Fidelity analyzed the situation both on a macro level and fund by fund. The result was a greater emphasis on diversification. This strategy ensured that even amidst turbulence, portions of client portfolios were hedged against specific market risks. It wasn't an abandonment of Fidelity's long-term growth mindset, it was an acknowledgement that there were ways to pursue growth with a more nuanced understanding of the economic cycles. Perhaps even more significant was the rise of money market funds. These short-term, low-risk instruments exploded in popularity during the 1970s. These offered higher yields than traditional savings accounts in a period of high interest rates. Fidelity recognized this shift and moved aggressively into establishing highly competitive money market funds. This added an essential tool for clients seeking stability and liquidity. It was a prime example of adaptability, not turning away from the core business, but evolving to meet current client needs within the larger market context. Edward C. Johnson II, or Ned, remained a towering figure as chairman, and in 1972 his son Edward Johnson III became president of Fidelity. Despite the transition, the core values established by Edward C. Johnson II remained remarkably consistent. The emphasis on research, fostering a talented workforce, and long-term investment horizons persisted. Fidelity remained focused on building long-term relationships with clients. This consistency across multiple generations of leadership is a significant factor in the company's enduring success. Chapter 5: Fidelity Today. From its humble beginnings managing a single mutual fund in the depths of the Depression, Fidelity Investments has blossomed into one of the world's financial behemoths. The numbers tell a story of remarkable success. As of December 2023, Fidelity has a staggering $5 trillion in assets under management, and they have a whopping $12 trillion in assets under administration. It serves nearly 50 million clients globally and employs a workforce of over 70,000 employees spread across the world. While mutual funds remain a cornerstone, Fidelity has diversified to meet the needs of a modern investor. 401k plans and other retirement products are major drivers of growth. Again, this emphasizes its long-term investment philosophy. Additionally, Fidelity has become a major player in the exchange-traded fund market. It offers investors a low-cost, index-tracking way to gain exposure to various sectors and asset classes. Beyond traditional offerings, Fidelity hasn't shied away from innovation and adapting to changing client demands. It now operates a sizable discount brokerage arm. This allows self-directed investors to buy and sell stocks, ETFs, and other securities on their own. And it caters to more active traders with platforms like Active Trader Pro. This platform provides real-time market data, advanced charting capabilities, and sophisticated order execution tools. Fidelity was among the first to offer fractional shares trading, breaking the barrier of only being able to buy full shares of stocks and becoming particularly attractive to younger investors with smaller sums to work with. Fidelity also consistently invests significant capital in research and development. This helps the company to stay in the forefront of technological shifts within the financial industry. An example is cryptocurrency. While not offering direct crypto trading at this moment, Fidelity is actively involved in this space. Fidelity Digital Assets provides custody and execution services for institutional investors interested in Bitcoin and other digital assets. Fidelity is also exploring the uses of AI in everything from portfolio optimization and risk analysis to personalized financial planning tools for customers. Beyond cryptocurrency, Fidelity sees the potential for blockchain technology in streamlining back-office processes. This will improve record-keeping and assist in exploring new financial products. Fidelity's journey mirrors, in many ways, the evolution of the American and global investor. From its early focus on democratizing access to stocks, to its embrace of the retirement savings revolution, to its exploration of bleeding-edge technologies, Fidelity has remained a major force in how millions of people around the world interact with their money. The reserved Boston lawyer who quietly took over a struggling fund could hardly have imagined the empire his vision would one day spawn.